Welcome to this video about support and resistance. After completing this video, you will be able to describe support and resistance, identify and mark these zones in price charts, and lastly, explain the significance of support and resistance zones. Let's get started. The main question that comes to mind is, what is a support? A support indicates a particular level in a price chart, where falling prices are expected to find some support. In this case, what we are trying to imply is that ongoing down moves will most likely halt and in most cases reverse upwards into an up move from this level. This is an example of what a support level may look like. As you can see, the price has bounced back up twice from the exact same price level. This indicates that if prices were to return back to this level, we may most likely see it reversing into an up move. Now let's move on and learn about a resistance. A resistance in price charts indicates a level from which you can expect prices to fall. This means that any potential up move is most likely to halt in this zone and then reverse into a down move. So this is the exact opposite scenario of that of a support level. Here is an example of what a resistance level may look like. As you can see, prices in an up move will enter a resistance level and eventually reverse into a down move. Now that you have some understanding of the concept of support and resistance, let us move on to TradingView, where we will try to identify these levels in real charts. Here we have opened a price chart of an asset. As you may have observed, we have a swing low here, and hence we mark the same as a support level. We also extended backwards, just to check if this support level has been respected in the past. And as you can see, here it did reverse into an up move. Now let us mark a resistance level. This will be a price level where you can find multiple swing highs, that is, reversal of up moves into down moves. So this level right here is a level from where the price has strongly reversed twice. Hence we mark it as a resistance level. Another thing you should keep in mind is, the levels that we have marked here must not be considered precise levels, rather they should be considered zones. You can use the rectangle tool and mark the same in this manner. Also remember, you can identify multiple levels of support and resistance in a chart. However, while analyzing a chart in real time, you can identify the nearest support and resistance levels in this manner. First, you identify the most recent swing high. It must be higher than the current price. And then you can mark this level as a resistance. Further, you can also check if the same level has acted as a resistance in the past, as it will help you gauge the strength of the resistance level. So this level will be our nearest resistance zone. Similarly, to identify the nearest support, we will now look for a recent swing low that is below our current price. And then, we will mark its price level and check for upward price reversals in the past. Since we have a swing low at this level, you can mark this as your nearest support level. This has also shown some minor support in the past. If you are looking for an even stronger support zone, you can see that the price level here contains 3 swing lows and has acted as strong support in the past. Hence you can mark this same and refer to this price zone as a stronger support level. Now that we know how to identify the support and resistance zones in price charts, let us look at the rationale behind the same. At a support zone, clearly, the demand for the asset is usually high and exceeds the overall supply pressure. This may arise due to various factors, such as the asset looking slightly undervalued and excessive presence of buyers, etc. Similarly, at a resistance zone, the available supply is far greater than the demand for the asset. Such immense selling pressure is the key factor that leads to sudden down moves from this level. Let us quickly summarize our learnings from this video. A support is a price zone from which we expect down moves to reverse into up moves. And at a support zone, the buying pressure for the asset tends to be very high. In a similar way, resistance is a price zone from where we expect rallies to lose some steam and eventually reverse downwards. This is due to excessive selling pressure and weak demand for the asset. Lastly, we also learned how to mark support and resistance levels in price charts. You can identify the nearest support and resistance levels in real time by simply identifying the closest swing highs and swing lows. And to find even stronger levels of support and resistance, you can shortlist the levels that have acted as support multiple times in the past. That was all for this video. In the next video, we will have a look at these support and resistance levels in action.
Welcome to this video on the Fibonacci ratios. After completing the video, you will be able to describe the concept of Fibonacci ratios. You will also explore its relevance in trading, and you will be able to explain how Fibonacci ratios can be used to detect hidden levels of support or resistance during a retracement in a long-term trending phase. So let's get started. The Fibonacci series was brought to light by a renowned mathematician in the 11th century. This series of numbers start from 0 and 1, and each consecutive number is determined by calculating the sum of the previous two numbers. For example, 0 plus 1 is 1, 1 plus 1 is 2, 1 plus 2 is 3, 2 plus 3 is 5, and so it goes on. But doesn't it look just like an ordinary series of numbers? What can be special about it? The reason why the Fibonacci numbers are given so much importance is because this very sequence is observed in many aspects of nature. For example, most flowers tend to have either 3, 5, 8, 13, or 21 petals. Another interesting property of the Fibonacci sequence is that, if you divide any Fibonacci number by the previous number in the sequence, you will see that the ratio always comes close to 1.618. And this very number is also popularly known as the golden ratio. The spiral pattern obtained after plotting the golden ratio also holds close resemblance to many naturally occurring patterns, such as the formation of seeds on a sunflower, the spiral structure of seashells, or for that matter, even the shape of most galaxies in the universe. Since the Fibonacci series is present in so many aspects of our lives, isn't it likely that these levels may hold some importance in price charts too? Well, many technical analysts believe that the Fibonacci levels play an important role when it comes to trend-based trading. Now, you may or may not agree with this view. But one thing for sure is that there is no harm in giving it a try. Let us have a look at how the Fibonacci numbers can be used when it comes to trading. To apply the Fibonacci series for trading, we need to first compute some important ratios. If you divide any number by the next number in the series, you will find that the results get closer and closer to 61.8%. And in a similar way, if you divide any number by two numbers ahead in the sequence, you will see that the results start coming close to 38.2%. Repeat this with three numbers ahead, and you will see that the ratio turns out to be approximately 23.6%. The other two ratios that are used for trading are 50%, which is 1 by 2, and 78.6%, which is simply the square root of 61.8%. And there, we have all of the important Fibonacci ratios. So what's next after identifying all of these levels? You probably know that the prices in charts often move in waves. Based on this, any trend can be broken down into two main fragments. First, there are the strong impulsive moves, and then there are the corrections. Ideally, as a trader, you always want to capture the impulsive moves. But how would you know when a correction is over and a new impulsive move is about to emerge? One of the ways, as you may have guessed, is by using the Fibonacci ratios. For this, you can simply mark the start and end points of a clear directional trend. The start and end would represent the 100% and 0% levels respectively. Then, you can plot the Fibonacci ratios, that is the 23.6%, 38.2%, 50%, 61.8% and 78.6% levels. The 38.2%, 50% and 61.8% levels seem to hold the most significance when it comes to identifying the end of a retracement or correction during any given trend. During strong uptrends, usually prices tend to retrace up to the 38.2% or the 50% levels. However, occasionally it may also retrace all the way back to the 61.8% level. And if prices move below the 78.6% retracement level, it would indicate that the existing trend has come to an end and prices may continue moving in the opposite direction. So to summarize, as per the Fibonacci ratios, you can expect the majority of the retracements to occur at the 38.2% and 50% retracement levels. That was all about the interpretation of the Fibonacci levels. In the next video, we will move one step ahead and apply the same concept on a real price chart with the help of TradingView. So stay tuned.
Welcome to this video on Fibonacci in action. In this video, we will move one step ahead and apply our learning from the previous video to a real price chart. After completing this video, you will be able to visualize the Fibonacci price levels on price charts. And lastly, you will also be able to interpret the basic trading positions to be taken based on the Fibonacci retracement levels. So let's begin. To get started, you can visit TradingView and open up the price chart of your favorite asset. Next, you can select the Fibonacci retracements tool from the toolbar. Now, identify any clear uptrend and mark the start and end points using this tool. As you can see, all the important levels will automatically be visible for the uptrend. Now, let us have a look at what trading positions we can consider based on the Fibonacci levels. Now you may recollect from the previous video that ideally, most retracements tend to reverse from the 38.2% or the 50% levels. So let's assume that each time prices enter this zone, we will buy the asset. As you can see, the prices have entered the buying zone. So we can buy Amazon at this level and keep our stop loss at the 61.8% level. Seems like the trade worked in our favor, as the price could cross the highest point of the uptrend. Now, let us repeat the same process. As you can see, a new uptrend seems to have developed. Now, let's mark the Fibonacci levels and wait for prices to enter our buying zone. Unfortunately, this time the prices did not retrace back to our buying levels. However, don't worry, you can always expect more opportunities in the future. Moving on, as you can see, a new uptrend has emerged. And it does seem like a good opportunity to enter with a buy position. So let's enter this trade with a stop loss at the 61.8% mark. Seems like once again the Fibonacci levels worked. Let's wait and check for another opportunity. Looks like we had a good retracement right here. And the prices too seem to have entered our buying zone. So we can go ahead with a buy position. But moving on, we can see that this time, the prices could not even cross the 23.6% level. Instead, the prices reversed downwards, and we would have exited with a minor loss. Another interesting thing to note is that prices also breached the 78.6% level. And this could be a possible indication of an emerging downtrend. Let's wait to see if it holds true in this case. It does seem like the 38.2% level is acting like a good resistance level at this point, and prices too are constantly breaking the previous lows. And there, we have a 100% retracement. This implies that the entire uptrend has been reversed. So that was all for now. Hopefully, by now, you are excited to use the Fibonacci tool and interpret the results by yourself. In the upcoming video, we will create a proper trading strategy based on the Fibonacci levels. So stay tuned.
Welcome to this video on the Fibonacci retracement strategy. After completing this video, you will be able to explain the workflow of the Fibonacci trading strategy. Further, you will determine suitable exit levels, that is the stop loss and take profit levels for the strategy. And lastly, you will also find yourself capable of refining the Fibonacci strategy using your own conditions. So let's begin. In the previous video, you learned that the Fibonacci levels can be plotted based on the start and end points of any trend. But while it is simple to detect the start and end points visually, how can you programmatically identify the same? You can start off by specifying a look-back period. For example, let's consider it as 1 year. Now, based on this, we will only be looking at the past 1 year's historical data from any given trading day for all of our calculations. Assuming that a 1-year price chart looks like this, we can detect the start and end price levels easily by using the min and max functions of the pandas library to find the highest and lowest price values. Let's assume that we want to identify the Fibonacci levels for an uptrend. To verify if the data we have at hand is that of an uptrend, we can check for a basic condition. The condition is that the recorded date of the max level must be more recent as compared to the date of the min level. Additionally, we can also specify a certain threshold to ensure that the uptrend is of a decent magnitude. For example, here we check if the range of min and max minus min, is at least 25%. Assuming that our setup looks similar to this, we now also have to decide on a buying zone. In the previous video, we understood that a majority of the retracements tend to reverse from the 38.2% or the 50% levels. So for long positions, we can simply wait for prices to enter this zone and buy the asset once prices close between the 38.2% and 50% retracement levels. Now, our basic framework for trading based on Fibonacci is ready. So let us move on to determining the exit levels. That is the stop loss and take profit levels. For an uptrend, we can set the stop loss anywhere below the buying zone, and the take profit level can be set above the buying zone.
But how about setting them based on the Fibonacci levels?
That's a great idea as well. Since we already have the Fibonacci levels, you can set the exit levels at the Fibonacci levels that are close to the buying zone. So that means for an uptrend, we can set the stop loss at the 61.8% level and the take profit at the 23.6% retracement level. And there, we have our strategy complete. But are there any more conditions that we can add to improve this strategy?
So far, a limitation in our strategy is that we aren't checking the direction from where the prices could possibly be entering the buying zone. For example, during an uptrend, based on our existing conditions, the prices could also enter the buying zone from below. We must not be trading on such scenarios because it is clearly not a retracement. So how can we solve this problem?
To ensure that the signal is generated only for valid retracements, you can compute a moving average for a month's period, that is, 21 days, and add a condition as follows. For a buying signal to be valid, the 21-day SMA value must be greater than the 50% retracement level. This will ensure that the prices approach our buying level from the upper direction, indicating that it is a retracement of the existing uptrend. That is all for now, and it seems like we have come up with an interesting strategy. In the upcoming video, we will address a few additional questions that may cross your mind regarding this strategy. Welcome to this video on the short selling strategy with Fibonacci retracements. After completing this video, you will be able to apply the Fibonacci strategy to downtrends. Let's get started. In the previous videos, we learned how to identify the Fibonacci levels. The first step involved here was to identify the start and end points of a trend. Note that during uptrends, the start point is always the lowest price and the end is the highest price. However, a downtrend always starts with a higher price and ends at a lower price. Let us quickly visit TradingView and mark the Fibonacci levels for a downtrend on an actual chart. As you can see, we have a clear downtrend visible in this period. Now to visualize the Fibonacci levels, you can simply use the Fibonacci retracements tool and mark the start and end points of this trend. And there, we have successfully identified the Fibonacci levels. Now that the levels are identified, how can you trade this setup? We would be trading in a very similar manner as we did in the long Fibonacci strategy. However, the key difference lies in the fact that here we would be taking short positions instead of long positions. So once again, the levels for the entry zone remain the exact same. That is, we wait for prices to close inside the 38.2% to 50% zone. Once we have a close within this zone, you can initiate a short selling position. The stop loss can be placed above the entry level and take profit anywhere below the entry level. For example, once again we can use the 61.8% level as our stop loss and the 23.6% level as our take profit.
But what about the additional conditions we used in the long-only strategy? Do we need to change all of those?
Yes, we will have to make changes to a few of the conditions before we decide to trade algorithmically. For example, during a downtrend, instead of checking if the recorded date of the max price is greater than the date of the min price, we would check the opposite. That is, we will check if the date of the min price is more recent than the max price. Also regarding the range of the trend, we will have to change the sign of the threshold. That is, you can check if the range between min and max prices is greater than, say, minus 25%. And lastly, you would need to check if the 21-day SMA lies below the 50% retracement level and not above it. This would be to ensure that the generated trading signals are that of retracements only. So that was all about the changes. In the upcoming section, we have an interesting capstone project that you can attempt. So stay tuned.